With the stock market and specific stocks reaching all-time highs on a weekly basis by now, let's touch on two stocks that are being overlooked for good and bad reasons, but I do think that these two stocks could energize your portfolio in 2025. Yes, I did use the words energize because these are energy stocks. Good one, couch investor. Thank you. Tapping myself on the shoulder for this one. Anyways, these stocks have had headwinds, but I do think that we're going to see some tailwinds in 2025 despite a Trump presidency. I'll explain all of that in this video. The first company we're going to touch on is First Solar. So if you're interested in those types of videos, hit the thumbs up button, subscribe if you're new here. We're well on our way to reach 60,000 subscribers, so thank you very much for all the support. And if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So first company, First Solar. First company, First Solar. Another good one. Anyways, this has a market cap of just over $20 billion, a forward PE of 9.7 times. Now, year to date, the stock is only up 8.75%. It was up much more, but we've seen a huge decline in these types of companies. Over the last 3 years, this stock is still up 81.15%. Now, this stock was on my screener, which I touched on Sunday. Why is that? Well, because we're seeing accelerated growth. We're seeing sales growth of 28.7% in fiscal 2024 and then 30.25% year-over-year growth in fiscal 2025. We're also seeing EPS growing extremely fast, 64.7% in fiscal year 2024, then expected growth close to 60% in fiscal year 2025, and then another close to 40% year-over-year growth in fiscal year 2026. Again, these are the current expectations. These things can go up and down over time. Currently, the average analyst price target sits 45.3% higher than the price we're at today, and we did have a lot of price target adjustments after the latest earnings report because the number did fall a bit behind and the updated guidance as well. So before that earnings report, the average price target was $287.7. Now we're at $272.3. Now looking at some pricing metrics, it's quite clear that on a forward PE, we are much cheaper than the 5-year mean. Actually, we're cheap just period, 9.7 times forward PE for a company that is expected to grow that quick in the next coming fiscal years. I mean, that's a good price to pay. Then you've got EV to EBITDA 7.1 times, price to sales about the same, 3.7 times. Free cash flow has been hit because of all the investments, new facilities in the United States, etc. But once those things are over, I do expect free cash flow to be positive yet again. And then price earnings to growth at 0.32. That signals that, well, it's extremely undervalued right now. So zooming out and looking at what First Solar has done throughout the last couple of years and what's expected to do in the next 2 fiscal years, we can see that revenue has grown quite nicely. It's actually up 146.7% since 2020. And as you can see, free cash flow has been hit, but it is expected to recover quite nicely in fiscal 25 and 2026. I mean, that's over 50% growth from 25 to 2026 when it comes to free cash flow. As for the margins and net income, we can see that net income has recovered since the lows here in Q1 2023. You can also see that gross profit margin has recovered quite nicely. So we're seeing a recovery from that standpoint, although with the capital expenditures increasing, it's no surprise that we're seeing free cash flow in negative territory. And so last quarter, net sales came in just short of $1 billion. The decrease was primarily driven by a decrease in volume of megawatts sold and a product warranty reserve charge, partially offset by termination payments from certain customers in the US and India. They said the following: as we approach the end of 2024, we remain pleased with the progress made across our business, navigating against a backdrop of industry volatility and political uncertainty, with a continued focus on balancing growth, profitability, and liquidity. We expect that our disciplined long-term approach will allow us to work through the outcomes of the upcoming US elections, as well as the continued volatility across the solar manufacturing industry. As for guidance, this is basically the updated guidance. So it's a bit of a reduction across the board for net sales, gross margin, operating expenses, operating income, etc. There's a reason for that. Well, they gave us a couple of reasons for that. So First up, operational challenges. So several operational hurdles, including hurricanes, supply chain disruptions, and a security incident, that's with the CrowdStrike issue in July that has impacted that business. Those have impacted production and logistics, leading to adverse effects on operational and financial performance. Then with regards to India, the ongoing issue of Chinese dumping in the Indian market has depressed domestic solar panels ASPs. While the Indian government has initiated an anti-dumping investigation, the immediate impact on pricing remains negative. With regards to delivery schedule shifts, some customers have requested changes to their delivery schedules due to project delays, leading to a backloading of revenue and gross margin into the fourth quarter. The last point here is with regards to Plug Power. So First Solar has enforced its contractual rights in cases of breach, including the termination of the Plug Power contract and 2 contracts in India. While this has led to termination payment entitlements, it has also resulted in reduced sold volume and potential legal proceedings. So those are basically the reasons why we're seeing this updated guidance. Now, all in all, right now what we're seeing for demand, year-to-date net bookings of 4 gigawatt, 0.4 gigawatt of net bookings since previous earnings call. Current contracted backlog of 73.3 gigawatt, that's a big number, by the way. Opportunity pipeline of 81.4 gigawatt, including 23.5 gigawatt mid to late stage. With regards to manufacturing and technology, they inaugurated the Alabama facility in Q3, and Louisiana expansion is on schedule. This is, of course, capital intensive. Now, looking at the chart real quick, we can see that $180 might have been or could still be a solid rebound area. It was previously an area where the stock was rejected a little bit. So maybe the rejection, previously resistance, can now be a support area. As you can see in the last couple of weeks, this stock was just above $180, and then we've seen a little rebound. Momentum is definitely not with this stock or a lot of energy stocks. RSI is trending lower, still nowhere near being oversold on the weekly. But touching back on, well, the Trump presidency and stuff like that, yes, these type of companies are, of course, benefiting from tax credits, but they're also building in the United States. And I do think that the companies that are building in the United States, creating jobs in the United States, making sure that the United States will become a leader in renewable energy, I think these companies will still benefit from a tax credit of one sort or another. I don't know exactly which one, if they'll continue with what's happening right now or that will be tweaked. But I do think that companies like First Solar or the second company I'm going to talk about, enphase, will not be impacted as drastically as, well, the price action indicates. That's just my opinion right now. Of course, during the next couple of months, we will see what will change. But I do think that the companies that are manufacturing, building, creating jobs in the United States will still see some benefits for years to come, because we are talking about renewable energies. We're not talking about forcing people to buy EVs or stuff like that. No, this is purely about renewable energies, solar, battery storage, etc., etc. And I do think that these things are not on the chopping block, or at least not yet. Now, switching to company number 2, and that's enphase. Now, enphase has had a terrible year. The stock is down year to date 53.5%. Over the last 3 months, the stock is down close to 50%. In the last 3 years, the stock is down 75.8%. It has a forward PE of 17.9 times and a market cap of $8.29 billion. Now, enphase is a company that is way more affected by high interest rates compared to First Solar. So going into 2025 with interest rates coming down, that should benefit a company like enphase. Now, for fiscal 2024, this is not a good year for the company. Top and bottom line, huge decreases year over year. But then in the next 2 fiscal years, the expectation is that, well, it's going to reaccelerate and then some. So 32.3% year-over-year growth in 2025, followed by close to 20% year-over-year sales growth in 2026. As for EPS, expected to grow 77.5% in fiscal 2025, followed by another 26.4% year-over-year growth in fiscal 2026. As for the average analyst price target, that still sits 61% higher than the price we're at today. And here as well, since the last earnings report, the average analyst price target has come down quite a lot, from $123, $124 to now $99. Looking at some pricing metrics, currently enphase is much cheaper than its 5-year mean on a forward PE basis, EV to EBITDA, price to sales, price to free cash flow, and even, look at price earnings to growth, also under 1, which means it's in undervalued territory. But of course, these are all based on the expectations. The expectation that 2025 will be a much better year for companies like enphase. And so looking at enphase and the current expectations, we can also see that free cash flow is expected to rebound. And here in this case, free cash flow has stayed positive, which was one of the positive things of the bad reports in the last couple of quarters. So that's nice to see. We'll do a quick reverse DCF later in this video. But the bad picture is, of course, this, right? Huge deceleration in revenue, huge deceleration then, of course, in free cash flow, in net income. We did see a small rebound in gross profit margin. So yeah, at least there is that. But yeah, the market is definitely looking for a continued reacceleration of revenue growth. And so for last quarter, that's what we've seen. But this is again just one quarter, right? Revenue came in at $380.8 million compared to just $303.4 million in Q2. But that's a huge, huge decrease, right? From the $551 million same quarter a year ago. Margins are still fine. Free cash flow was $161.6 million. So that's quite okay. But the market still wants to see revenue continue to go up and up and up quarter after quarter. Now, with regards to enphase, of course, it's not just the microinverters for the solar panel. They want to control your whole ecosystem at home, right? So it's the microinverters, it's the app, it's the EV charger, the combiner, the battery, etc., etc. Why is that important? Well, it's important because they want to grow their share of wallet, right? Starting with just 2,000, the enphase potential per home with just the microinverters. That was back in 2019. Then they added the battery, so the potential went from 2,000 to 9,000. And then if they add even more load controller, EV charger, grid services, AI software, etc., etc., they're reaching already here $12,000 per home. So that's basically what they're going after. But as you know, in a high interest rates environment, all of these things, if you cannot get favorable terms, these things cost quite a lot of money. Now, as for the fourth quarter outlook, so revenue, if they can reach the top line of the guidance, that means that we're going to see a growth quarter over quarter, since we've seen $380 million in revenue for Q3. The midpoint here, the midpoint is basically also 380, so hopefully it can be a little bit more than that. GAAP gross margin to be within the range of 47 to 50% with net IRA benefits. So here as well, we have to think about what happens with the IRA tax credit. Does it go away? Does it not? Is it getting adapted? Etc., etc. These things will impact a company like enphase, but I do think that these things are already priced in. So in short, the difference between First Solar and enphase can be seen here on the screen. The core business for First Solar is manufacturing solar panels. The core business for enphase is manufacturing microinverters. I'm talking about the core business, not the whole business. The product focus for First Solar is solar modules. For enphase, it's solar microinverters. Role in solar system is that First Solar provides the primary component for generating solar electricity, which means that enphase could very well be a First Solar customer. For enphase, they optimize the performance of individual solar panels. As for market position, First Solar is the leading manufacturer of thin film solar modules, and enphase the leading provider of microinverter technology. Doing a quick reverse DCF here for enphase, we plug in the trailing 12 months free cash flow, that's $336 million. Terminal growth rate 4.44%, discount rate 8.48%. That's because we take the implied equity risk premium plus the terminal growth rate, you get that number. Also put here a 2% dilution for the next 10 years. And so the implied growth rate to justify today's price is 6.3%, which if you looked at the expected growth for free cash flow in the coming fiscal years, seems quite reasonable, right? Even on the low side. But of course, we have to think about what's going to happen in the next coming quarters, the next coming years with regards to, interest rates coming down, IRA tax credit, etc., etc. And so looking at the graph right now, it's clear that the $80 mark, the support there was non-existent, but now we're at the $60 mark, which previously was a resistance point. So maybe this time again, you turn a resistance into a support area. Right now on the weekly, it's a green candle. So maybe the stock might have bottomed at $60 here. We went from being oversold on the weekly to now just not oversold. So maybe this is a start of a small recovery. Now with regards to enphase and maybe First Solar as well, but I didn't check, the options game, especially leaps, can be very, very interesting to play right now. You can also sell puts. This is something that I'm learning each and every day. The options game is quite interesting. And if you can look at the January ones, the prices for $160 or so are not that crazy, right? Because we know that if enphase does show continued growth, and if next year, interest rates continue to come down and the IRA tax credits are staying in place, we could see a huge move for companies like enphase and First Solar and probably some other players in the energy industry as well. So yeah, maybe if you don't want to buy these stocks directly, if you want to have options, I think long dated options could be an excellent option. Good one for you right now, because well, you reduce the risk a little bit since you're buying 2026 ones. So yeah, let me know if you're an options expert. Let me know if that makes sense. If you like these types of companies, do make your argument down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye bye.